Welcome back guys to another Zero DTE video, and today Coach Ernie is going to be talking about volatility, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description to find Coach Ernie's Skool Community. Enjoy guys.
I'm going to look at a case between two different butterflies and what they look like in high volatility versus low volatility. And we'll do a very simplified look. We'll just look at an at-the-money butterfly, put on at the exact same time. They're the exact same width. It doesn't matter what the width is or what time it is. Let's say it's the morning. The only difference will be that one will be placed at the money in low volatility and one will be placed at the money in high volatility. And we'll look at the difference between high and low volatility. So here's a risk graph, bigger. And let's assume then that low volatility will be over here, and this will be the at the money, and then high volatility, the diagram for high volatility will be over here, and then this is at the money. Now, in low volatility, when you put that trade on, it's going to look something like this, all right? That same trade put on high volatility in the morning will look like this, all right? Notice the difference. You do notice the difference, right? You see it. This is the zero line right here. Can anybody tell me what the difference is?
Yeah, so lower volatility, the zero line is higher. High volatility, the zero line is lower.
That's correct. So another way to look at it, though, is that, let me just get another color. There's big risk in low volatility with little profit, and there in the high volatility there's little risk with big profit potential. So it's that potential that I really care about, right? Because that will give me my risk to reward. Obviously this risk to reward is on low volatility is nowhere as good as this risk to reward. They have way more potential. And there's another thing that happens when this occurs, because this chart that I've drawn, this risk graph, is the butterfly at expiration. That's the P&L diagram of a butterfly. But what it looks like at 4 o'clock at the end of that day, at the end of its expiration. All right. We know that's really not what we're trading every day. We're really trading the real-time version of that same strategy. And so when we put that trade on in the morning on low volatility, the real-time one will look like this on low volatility. And in high volatility, it'll look like this. So you can see very clearly that it has very little potential before it gets up to the top here in low volatility, but lots of potential in high volatility. But the most stark difference, besides risk to reward and potential, is the sensitivity to price. So if price moves, say 10 points like that in low volatility, you can see that going down the premium curve, it would come way down here. You're going to get a big move. You're going to get a big increase in the value. In high volatility, that same 10-point move only goes down about this much. So the value decrease is very small. That's your sensitivity to price. That is that slope right there, the slope, and this slope, which is very flat, that's your gamma. That's your gamma risk. So obviously being in a low volatility situation, we need to be far more adroit and quick and decisive on our profit taking. The sensitivity to price is much higher, the amount of profit potential is lower, and the risk is much higher. We get profit, we want to take it as quick as we can, or not as quick as we can, but you want to be much more nimble in taking that profit and not letting it go. In high volatility, it's like being at the beach. You got a lot of time, lots of potential, no real hurry. The chances of getting a pin trade increase dramatically over low volatility. Everything about it is just better, but we don't have a choice. We can't tell the market to give us the volatility we want. All we can do is react to it. So what this really means is that with low volatility, in order to protect ourselves from that increased risk, we have to take smaller trades. So what we do is we put on trades while we're trying to keep the same risk to reward. We put on much smaller trades in low volatility. In high volatility, we can afford to go much bigger.
Thanks for watching guys, I hope you enjoyed the video, and if you did, make sure you hit the subscribe button and the like button below. If you're interested in becoming a pro trader, remember to check out the link in the description for Ernie's Skool Community.